What's up guys, Jake here. In this video, we're going to continue talking about advanced options trading strategies, specifically debit spreads. And debit spreads are two of the four kinds of vertical spreads. Before you can trade vertical spreads, make sure you're approved for the appropriate level with your broker. Vertical spreads for Charles Schwab is level 2. And in my previous video, we talked about credit spreads, which is the bear call spread, the bull put spread. In this video, I'm going to explain and do examples of the bull call spread and the bear put spread. Maybe check out my last video if you're more interested in selling credit spreads. And think about it on the most basic level. What are the four kinds of options trades? And if you want to buy a call, simply, then that's considered a long call. Same thing with the long puts. If you own 100 shares of stock, then that is a covered call that you sell on a call. And if you have the money in your brokerage account to secure 100 shares, when you sell a put, that is a cash secured put. If I've already confused you and lost you, then definitely check out my playlist on trading options where I explain these more in detail with full examples. But these four kinds of basic options trades have an equivalent vertical spread trade. So the equivalent of the original four, if you buy a call, this is called a bull call spread. If you buy a put, this is the bear put spread. If you sell a call, the bear call spread. And if you sell a put, the bull put spread. I know these are pretty fun names, but it's really important to try and visualize exactly what's happening once you understand what is happening with these vertical spreads. Now, why would you buy debit spreads? And I argue it's affordable speculation. If you just buy a whole contract for a put or a call, these can be kind of expensive. And yes, for buying a call, your profits are technically unlimited, but realistically, is the share price really going to go that much higher? So by buying a debit spread, you're limiting your profits, but you're also making the contract you're buying more affordable. So a debit spread is just buying a put or a call for a debit. The debit means money is coming out of your account to pay the seller. And then you're also going to be a seller. You're going to sell another option for less premium than what you paid, a further strike price on the same expiration date. So your max profit is the width of the spread of the strikes minus the debit you're paying multiplied by 100. And your max loss is just the net debit. It's the same as buying a call or buying a put. Your max loss is the contract that you're paying for. Specifically for the bull call and the bear spread, for the bull call, you're buying one call option and then selling another at a higher strike price. It's the opposite for the bear puts. You're buying a put and then selling a put at a lower strike price. Don't worry, we're going to do examples in a second. So let's first explain the bull call spread, because in general, calls are easier to understand. And you would buy a bull call spread when you think the stock price of a company is going to shoot up in the near term. So you can actually buy bull call spreads in the money. I'm going to cover that in a different video, but let's just assume that you want to speculate and you're going to buy a bull call spread either at the money or just out of the money. So if the share price is currently here, your first strike price that you're buying a call on will be just at the money or out of the money. Now, the call that you just bought might be super expensive and you don't want to tie up that much collateral in one contract. So how you mitigate this is to sell another call at a higher strike price. And what's happening here is if the share price of the company shoots up, goes above your call that you bought, your contract is now going to expire in the money with intrinsic value locked in. However, once you get above this line where you sold a call, now you're losing money because the call you sold is now accumulating intrinsic value for the buyer of the call you sold. So you're capping your losses. Once the share price of the company goes above this line, anything that you're gaining for this call, you're losing for this call. So it's a way of basically creating a range in which this spread will make you a profit. Buying debit spreads has its advantages, and there are two specifically. One is it, in a way, negates implied volatility. So if implied volatility spikes or drops, you don't really care because the call that you sold is adjusting pretty much at the same rate as the call that you're buying. Obviously, this range is different, so the values are not the same, but it does mitigate the effects of implied volatility. Same thing with theta decay, and this obviously drives the premium for these two contracts. But as this call that you bought is losing value due to theta decay, this one is also losing value, but gaining you value as the seller. So in a way, it mitigates the effect of implied volatility and theta decay. And the max profit on this debit spread is the width of the strikes for the two contracts minus the net debit you made from buying and selling these two calls, multiplied by 100 because it's $100 per contract. And your max loss is just the net debit. So if you're completely wrong on this trade and the share price of this company trades sideways or goes down, then the most you can lose is what you gained from selling and what you paid for buying. Let's do an example with Netflix because this is kind of an expensive stock now. The share price of Netflix is $500. And we're going to do a debit spread and we're going to do a bull call first. So first thing you have to do is choose an expiration date. Now, the closer you do, like 1 week, 2 weeks out, the less it will cost you, but your probability of success is really going to drop dramatically. You need the share price of that company to move fast. However, let's be a little conservative and we'll choose an expiration date of 1 month in the future, August 20th. This is in 30 days. And once again, we're looking at the calls. Now we have to choose which call we're going to buy and which call we're going to sell. So let's go ahead and select the just out of the money strike price of $5.15 for the call that we're buying. And then we'll have a range of $10. So it'll be 1,000 with a strike price of $5.25 that we're selling. Now, if we were just to buy this call, we would have to pay close to $1,400. That can be kind of expensive for potentially not that much gain if, for example, Netflix in the next month doesn't get above $5.25. So when you select these two, your broker should start building the two legs of the trade you're going to make. Make sure that you buy to open the strike price closest to the share price, and you sell to open the one that's further away. So if you go over here and click on trade, you're going to get a quote based on the bid and ask prices, and it's telling me for D, for debit, I'm going to have to pay $450 to buy this bull call spread. So what's my max loss? And my max loss is $450 if I'm completely wrong on this trade. Netflix's share price trades perfectly sideways or goes down over the next 30 days. What's my max profit? Well, it's the width of these two strike prices, $10 multiplied by 100, minus the debit you're paying. This is basically your break even. You need to overcome what you're paying to play over these 30 days. So 1,000 minus 450 equals $550. Now, if that $550 isn't enough profit for you, you can always do multiples of these spreads. So if you go here to quantity, if you want to adjust these to be 10 contracts with these two strikes for this expiration date, then you're locking up, or you're paying a net premium of $4,500 to potentially make in 1 month $5,500. What's the return on your investment over 30 days? And it's $550 divided by the collateral you're locking up, $450. You could potentially make 122% on your money on this trade in 30 days. This is why buying options and buying bull call spreads is so appealing to some people, because of these dramatic gains you can make on your money over a short period of time. However, you always have to factor in, what is your probability of success? What is the probability you could lose 100% of the money you're putting up as collateral? So that was the bull call spread. We're now going to talk about the opposite. We're going to talk about a bear put spread. And with a bear put spread, like buying a put, it's because you think the share price of a company in the near future is going to go down. So step one is to buy a put, and usually you do at the money or just out of the money. If you want to buy a bear put spread that's in the money, you can do that, but you do that for different reasons. I'm going to explain that in a future video. So, step one, buy a put out of the money or at the money. And then you have to sell a put for a lower strike price, once again, out of the money. So when buying a call, your max profit is technically unlimited. The share price of the company can always continue going up. But when you buy a put, your profit technically is limited in that the share price of the company can go to zero. But when you do a bear put spread, you're putting a limit on how much profit you can make. So if the share price, if you're correct, and the share price goes down, your range of profit is between these two strikes. Once the share price of the company gets above this, then any money you're still making from the put that you bought, you're losing on the put that you sold. And like the bear call spread, you get these benefits where implied volatility and theta decay are negated a little bit, because if one contract spikes or loses value due to theta decay, so does the other one. And your max profit, once again, is the width of the two strike prices minus the net debit you're paying multiplied by 100, and your max loss is what you're paying for the debit. And if the strike price of the company trades sideways or goes up, then yes, you can potentially lose everything you paid for the debit of this spread. Let's do another example on Netflix. And before, with the bull call spread, maybe the share price had gone down so much and you said, no way, Netflix is a great company, it's going to bounce back in the next month. But potentially on a bear put spread, you're saying Netflix is grossly overvalued, there's way too much competition in the market, I think the share price is going to keep going lower than 509. It's very easy to look at a stock chart and see it both ways. So first, we're going to choose our expiration date. Once again, the closer the expiration date, the less you'll pay for your debit. But we're going to go 30 days out and look at the strike prices for these puts. Now, if we were to buy a put outright, that would be $1,500 potentially. Very expensive. So we're going to mitigate that by buying a put and then selling one with a strike price width of $10 per share. So we're going to go ahead and select these, and then in the chain that Schwab built for me, once again, you're buying the one closer to the strike price. So buy to open the one closer, and then you're selling to open the one further away. After clicking trade, Schwab will then calculate how much of a debit I have to pay, and Schwab is telling me that this bear put spread will cost me $490. So let's run the math. What is your max loss? It's what you're paying for the debit, $490. What is my max profit? It's the width of the two strike prices minus the debit you're paying to play, $490. My max profit is $510. So what is my potential return on my investment over 30 days? 510 divided by 490. I can make 104% on my money if I were to do this trade. And similar with all these other vertical spreads, if this isn't enough money for you and you want to tie up potentially 10 times as much, just do 10 contracts of each, and then you'd be tying up $4,900 on this trade, potentially making a profit of $5,100. Okay guys, those are the 4 kinds of vertical spreads. I will be doing additional examples in future videos, so be sure that you subscribe and you check out that playlist on how to trade options. Now, before I let you go, I do want to put another disclaimer in this video to sell everything prior to the contracts expiring. Now, if your spread is completely out of the money, you're losing all your premium, you probably should still buy to close and sell to close your contracts, even if it's like $5 you're getting back in extrinsic value on the last day. But when you hold these spreads into the after hours of Friday, weird things start happening when you hold, potentially 40 contracts on Amazon. So when you hear these horror stories of people with their accounts blown up with like a negative $700,000 balance in like their Robinhood account, it's because they were doing vertical spreads and they did not buy to close and sell to close on expiration or before expiration. So to avoid any weirdness, just buy to close, sell to close every time before expiration. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions about vertical spreads, let me know down below. I love hearing from you guys. Till the next video, take care.